the designated representative for New York City Control Lander in attendance via
Good morning, or good afternoon, rather.
Microsoft Teams.
Oh, WebEx.
Agenda item number 1 to be considered is the minutes of February 27th, 2025 Executive Committee meeting, which was included in a package sent prior to the meeting. May I have a motion to approve these minutes? Motion by Green. Do we have a second?
Second.
Second, Alice Hold. All those in favor, please say, well, first, is there any discussion? Any discussion? Seeing no discussion, all those in favor of approving the minutes from February 27th, please state if you're in favor.
Aye.
Any opposed? Any abstentions? The motion carries. We have one contract item for today's meeting. It's an extension of MSCI portfolio. May we have a motion to consider? Motion by Kareem. I have a second. Second. Frank with a second. So there, can you tell us more about this?
Sure. Hi, everyone. So, MSCI, it's the name has changed. It used to be CAISA that we used to use. It's a portfolio analytics tool. It's been with BERS for a very long time. It's been something I inherited from the Antonio era, and we've been able to enhance it and use it. And it's not just the investment department. It's been something that's been, I know Vanessa has used it. If you logged in, we've had our fiscal ops folks use it. And it does utilize, John has sent a message, I think last night, about State Street data and so forth. So it does utilize some of that, but it also makes some enhancements that make it useful for us. And so some of those enhancements are, we do enrich the data so that you're able to see the information. We can do data quality checks on it. And it also provides lower latency than State Street information. So if you're looking at the quarterly information that you would get from just relying on custodian data, the amount of delay and the type of delay you get in the performance data changes on month 1 of a quarter versus month 2 versus month 3. And what we're able to do is basically make it uniform. And so that if you're looking at reports, and I can share, for example, optimize for text and images. Let me share my window if I can. You can see some of the reports, for example, on the screen. And you'll notice that sometimes the as of dates, so these are the reports just from last week, the as of dates are sometimes March, sometimes December. And sometimes it's a mix of, like, when it doesn't come from us, it's a mix of how do you look at a composite aggregate of performance data when the public information is known pretty much day by day, but yet there's a lag on private market data, for example, and sort of aligning that and getting a better representation. That's sort of the work that gets done and that we're able to do through this MSCI software. There's other things like getting some deeper dives to look at geographic cuts, sector cuts. There was a question in one of the executive committee meetings about our exposure to Israel, for example. And Vanessa and Bertrand were able to pull up that information just like that right in the middle of the meeting. You can answer the question, make a decision. That would be almost impossible to do based on a static report from State Street. And then sort of last is we have a very rich set of benchmarking information that we can sort of analyze with investments. So this is a small technology solution that we've had for a long time. It is a 9-month extension on it. It's $80,000 for that, basically to continue the service, and that's what the contract is, and that's what it's for. Oh, and one last thing is, trustees do have access to it, and some have logged in historically if you wanted your own, but it's not like something you're going to necessarily want to do from your digital device, but it is something that has a variety of applications.
So is it because, oh, I'm sorry. Is it because the difference between the public and the private data that it collects? Is it because you have different data expectation? Different, like,
No. So what we've done historically is we were able to use basically more public market proxies within the system to sort of estimate from the as of date. So let's say it's for private markets, the as of date could be the end of the third quarter, the end of the fourth quarter calendar year. But there's public market proxies that can sort of bring expected values of that a little more current in your estimate. And then we're also populating information, for example, unfunded commitments and other things that give us a better sense on where we are when we're making decisions on investments in terms of pacings and other things. And that's information that we literally kind of work to enrich the data.
okay. I just want to unpack something real quick, because there has been, and I'm representing the civilian minds. There's this air that public and private is so different. Private is private, and public is public. So now you have a software that holds both, and I'm saying that they have two different, slightly rules of engagement. Is that what is causing the lag? Because they have different expectations, different.
Well, that's what's happening in the industry. There is a general lag in the reporting. And so if you're looking at the custodian reports, the information isn't as, in fact, I can show you the most recent report still has an as of date of December 31, and we're at the end of March right now. So we are able to get a little bit of a better estimate on what's happening here. I have it up on the screen. December 31. This is the most recent. This is from stage. We have a couple of these. So that's what's happening in the industry. This tool, one of the things it helps us do is just bring together as the entire portfolio of public and private markets, the best set of analytics. In fact, another thing I should have just shown right off the top is when you see this in the packet every month. I apologize, this is going across multiple screens here. But when you see this, for example, these charts are all done, and it's the most up-to-date information when we produce it from the tool, and that puts together the public, the private, and the assembly of different benchmarks that also look at public and private together in a way where you can actually see it and work directly with the MSCI folks if we need to make changes to the benchmarks, maybe to make it a little maybe more accurate. Yeah.
Any other questions? Tony?
Just following up on the email, so going back and forth. Given that the power of five is stronger than the power of one, and I'm assuming BAM is big, is a big ticket on their power products. Is there any way of maybe reducing cost, or by kind of banding together with BAM?
So I know Antonio did ask for one of the licenses, because we do get a share of the cost associated with BAR. It's pricey, it's a complicated tool, but we do get billed. I see the bills. So we did ask for a license. It was not approved at that time a while back for that, as well as for the State Street data. Yeah, I mean in my opinion.
Are they using the same tool that you're using?
No, they have State Street, the custodian. I mean, State Street has a tool called SSGA Live.
Right.
That's what BAM uses. I don't know, does BERS have a license to?
Oh, we used to, and it is something I'm going to get, but I wouldn't consider that.
Using Borrow One.
He is using Bar One. The State Street, I will request, and I'll probably get access to it because I know Antonio did have access to that. I was just stating at this time, what is the difference or what is the augmentation that facilitates? And this is a 9-month. I don't anticipate at this time like I'm not doing 9 months perpetually. So it is purposely designed.
I have a quick question as it relates to this service. Are we extending because it's our intent to do a new solicitation, or are we extending?
Yeah, so that
extending in the. I mean, are they the right solution that we're going to continue to work with, or are we extending because it just ran out and we have to do a new solicitation?
Oh, we ran out a while back, and it somehow we've kind of bridged this together. So instead of letting it just fall off, the contracting process in general across a number of services, as you know, is sometimes takes longer. So even though we started this a while back, the idea is, and I should also give a little bit of background and context. The overall technology spend, sort of within the investments for BERS, has sequentially gone down year over year. It peaked in Antonio's time. Our assets have gone up. This is one of the small sort of remaining ones. If we're looking at new innovative solutions, and there's a couple places where there's some, best in class solutions that you can sort of chop up and it won't cost more than this, but can give you very specific things that are needed at the time you need them. If for a couple of years you're very interested in specific private market solutions, benchmarking solutions, then you can sort of focus on that and get rid of this. And there is a potential, we're in the process of having an RFP to consider other solutions.
Yeah, I guess my question is, how long have we been with this firm?
This one's been around. It's like 8 years, or it's been a long time.
Okay. So the question is this an extension because we're doing another solicitation and exploring other solutions, or is it an extension and we're likely going to continue? I'm just trying to understand.
Yeah, so we're doing 9 months right now. At that time, we can make a decision, another 9 or just stop.
Is there something in place of it? Right?
Oh,
Not
we
just
are. No, we might. Because if you guys don't pass this, then I'm in a position to literally go without it. So and then we'd cobble up, something with State Street and maybe ask for borrow and things like that. So it is the hope to.
Well, good afternoon, everyone. I don't think I had the opportunity to meet everyone. I'm the director of contracts and procurement for BERS. So the negotiated service extension that we're doing right now, we're doing parallel to drafting the RFP, which will give the opportunity to other vendors to be able to provide us on their services based on the criteria.
So that hasn't started yet.
No, we're in the draft.
Okay. Which means that it's going to take longer than 9 months for it to be done.
Potentially, we're a bit ahead because we have a final scope. So it's just getting through the process of actually releasing it and then to.
Okay. And because it's a negotiated service, are we trying to do another negotiated service, or are we trying to do a true RFP to get more? Because a negotiated service is in essence a sole source. They're not a sole source, but we've identified somebody, put a contract in place. Are we looking to see if there's any other resources out there, or is it the hopes that we are doing an RFI or an RFP?
An RFP to solicit additional vendors. So it's not specifically catered to this vendor. It's to open up the competitive pool. The negotiated services is a mechanism in order for us to continue services without interruption with the current vendor.
Decision will literally be yours in 9 months. And I'm happy with whatever the decision is in 9 months.
Any final questions on this? Final questions? Okay, the recommendation before the committee is to approve $80,205 for MSCI/CAISA Portfolio Analytics 2. All those in favor, please indicate if you're in favor. Any opposed? Any abstentions? The motion carries. Next, we have introductory comments from our innovation and risk department lead, Sunil Mehta.
Hi, so I'm going to keep this, excuse me, brief, as I typically do. If it's just going to give a little bit of information on performance, and so
I'm sorry, can you speak up a little? Is that a helicopter?
Yeah, that's-
Oh, it is?
it is a helicopter.
Oh,
Yeah,
okay. It's like it's in the meeting.
yeah.
Yes.
I'm competing with a helicopter.
Trying to be out there, that's why you're out there.
Okay, so yeah, so I'll speak louder, and I apologize if there's competing sounds for the folks online. I'm actually getting scared now because I'm sitting next to the window. If there's a helicopter, you know, I've seen the movies, right?
What did Sandy get us into? Sandy, you have some explaining to do. Hey, hold it down, bro.
So you can see the these are typical performance charts. The year-to-date numbers are right now are they've come in at what we have here is about 4% fiscal year to date. The fiscal year to date's almost over in 3 months. You're just the screen, or it's on the agenda too, and the benchmarks are around 5.5. Now, what's happened over the last month? Public markets have fallen. They've had at least an intermediate term bottom in the middle of the month, but we've had this divergence again where our public, you can see it down here, our public equity domestic has it's now 6% less than our strategic asset allocation target. 5% is the corridor in the IPS, and our private equity is, rounded up 5%. So we're back to like 12.6% on private equity when our asset allocation target is 8%. So that's really what I have. Also, the 3-year numbers are also a tad below on 7%, around 5% return annualized. So that's where we are with performance at this time.
What's the next step?
The VIX in the 20s. Yeah, it's managed. That's the average too, right? Over a long period.
But the majority of the drop returns is coming from the US.
Right.
And the fact that we are 90% passive in the US, we have no protection, right? We're just following the market.
Right.
So that's where the drop. Non-US has been positive and US has been negative so far. And again, the only place where we have active management in non-US small and mid and small caps have taken the brunt of it. I expect that your small cap managers doing better, but the reality is that most of the allocation is in large cap, which has had the most losses. However, we're coming from 2 very good years in large caps. So it's down, but when you look at the last 2 years, it's not down. It hasn't erased the gains from the last 2 years, is what I'm trying to say.
This is primarily attributable to political machinations.
I mean, I think there's a lot going on. You have
No.
tariffs, you have AI, GDP growth in the US is expected to be lower, and a lot of companies have already started to lower their earnings expectations going forward. So there's a lot of competing themes, not just political.
So, but let me add that Bureau of Asset Management distributed their report March 12th. The March 12th report, 2 pieces of information are very relevant. One is 15-year returns for U.S. core equities with 12% compounded. Private equity, 15%. Right? 15-year. 3-year numbers are 12 for public equities, 5 for private equity. Private equity is dragging us down. And we are now outside the balancing ranges on both private equity and public. And I don't know how they're going to balance in because I don't know what they sell. We're just going to bring that on. One more piece of information for you. So it'll be 3 pieces of information. If you look at an index of private equity marks over the last year, trailing 12 months at the end of February,
private equity is up about 1 or 2%. The actively traded public managers of most of private equity, Apollo, Ares, KKR, et cetera, are down over 25% in the market trading. So
Oh, we still need to
private
get
equity is not doing as well as even
we need to get the updates the next time Nash is speaking among
Yeah.
trustees
I mean,
about
this
the
This is something that I think we need to hear from BAM about because we're way over allocated in private equity. I think the marks are understated.
Thank you.
We have to hear about what they're selling out of the portfolio. And we should be asking them about what they think the net cash flows will look like for the next year.
And it's gonna, the firm is still never turned down.
Yeah, they need to express an opinion on that because they're draining our public equity position
Right.
to fund private equity draws. And it's a problem.
or you could see if
Because we're moving from the better performing sector to the less performing sector
Tony, if you want to see
on
the
a
negative
relatively aggressive basis.
So our
contribution distributions.
So our fund, we're drawing, and the firms are not returning capital either. So they're
Right.
drawing from our best performing asset class to fund future, while we're not getting money coming back.
Well, here's the compounding thing. And this is like, now I'm in the realm of what my opinion is, right? Not the facts.
Understood.
But so if the reason these returns are so bad in private equity is because these are 2019 to 2023 vintages that invested when rates were very low, and now they got to sell into rates that are very much higher, which means they may not get back their original cost, which means we don't get cash flow, which means we go over our allocation, which means we back down our pipeline exposure and make fewer investments. And there's a good chance the vintages from this point on are going to look a lot better than the vintages from 2019 to 2023. And we will be underinvested. So we will have probably a decade of underperformance because of that. That's my speculation, because we won't have the money to pick up the good vintages that are coming in the next 3 to 5 years.
Reverse it out.
Exactly. It's a significant problem, and these are decisions that have been made over the next 6 to 12 months, which are going to affect us for quite a long time. And it's not like there was something we could have done about it, except not make new private equity investments, which we probably won't be.
I think you should have lowered the pace of private equity a long time ago.
And we did.
You did, but not enough, right? Because no one
shut it
knew
off.
that distributions, the managers were not going to distribute. Like, in hindsight, that's what you should have done, but that's hindsight, right?
Yep.
Because you really don't know what's going to happen in the future, and they're not. And while estimates say that private equity managers are going to start distributing, those are estimates. Until it actually starts happening, you don't know for sure that that's happening.
Well, they're borrowing from private debt companies that'll, affect that.
That's where the returns are going. Yeah. Nice companies, it's going to the private credit guys, not the private equity guys. That's why we're getting 15% on our private credit exposure and 5% on our private equity.
Hopefully some mitigation.
Yeah. Any other questions? Seeing none, thank you, Selena. And now we'll begin with agenda item number 4. We have a discussion. This discussion is in executive session. We'll have a motion to enter executive session. Second, Tony. All those in favor of entering into the executive session, please indicate in favor. Aye. Opposed, abstention, the motion carried. During this agenda item, we will discuss the proposed development market session, executive committee trustees, and one discussion of the proposed development market, entry by portfolio changes, and other portfolio plan matters. This was the last item on the agenda for today's meeting. The next meeting is scheduled for April Tuesday, 2nd at 12:30. And motion to adjourn. Second, Tony Giordano. All those in favor of adjourning the meeting, the opposed, we'll see another hour.
No,
See, all right, the motion carries. The meeting is adjourned.